Welcome to the weekly combo podcast, where I'll go over the highlights of the weekly update, the intermarket analysis update, the deep dive update, and the what to watch update. This is covering the week of June 30th through July 3rd for how things look for the week of July 7th through the 11th. Recapping what happened in the past week. The markets delivered a strong performance in a holiday-shortened week. The S&P 500 climbed 1.78%, reaching all-time highs, while mid-caps surged 2.9% and small-caps led with 3.4%. However, small-caps remained down 2% year-to-date, lagging their larger counterparts. The Nasdaq 100, and NYSE also hit record highs, with the S&P 500 forming a bullish golden cross during the week, a technical signal of sustained upward momentum. Low trading volume, driven by the July 4th holiday, was a factor, but the bulls were firmly in control. Looking at market trends and sentiment is riding high, perhaps too high. The Fear and Greed Index sits at 78, signaling extreme optimism, while asset manager sentiment is at a whopping 99.3. The S&P 500 remains firmly bullish, but overbought, as indicated by technical indicators such as the RSI, McClellan Oscillator, and a host of others. This suggests a potential pullback or consolidation in the upcoming week. Historically, though, early July is a strong period for the markets, but summer's lower volume could temper momentum. What were some of the key developments? Several big stories shaped the week. The Big Beautiful Bill passed, adding $3.3 trillion to the deficit, which sparked a 0.6% dip in the futures when they were trading on Friday, July 4th. On the economic front, employment data was robust, with unemployment at 4.1% and 147,000 jobs added, though private payrolls were softer than expected. The 10-year Treasury yield rose to 4.35%, lowering the odds of a July rate cut to just 4.7%, with a 95.3% chance of no rate changes per market data. Elsewhere, a new Vietnam trade deal and Apple's AI-driven product announcements provided a tailwind for the markets, particularly tech and materials. Speaking of sectors, materials led with a 4% gain, followed by tech, industrials, and communication. Growth stocks continue to outperform value, but value also had a very good week, while copper, silver, and bonds are still in uptrends, though gold is lagging behind stocks recently. Moving over to the intermarket analysis update, valuations are stretched, but they've been stretched for a long time, with the S&P 500's PE ratio well above 20 and the Shiller PE ratio at 38.31, well above the historic median and mean of 16 to 17. Megacaps are trading at 29 times earnings, while midcaps and small caps are a more reasonable 15.9 and 15.2 respectively. The markets can stay overvalued for extended periods, as we've already witnessed, but caution is still warranted. Growth stocks continue to outshine value in the bigger picture, with the peer growth index hitting highs and forming a recent golden cross. However, a shift toward defensive value could signal market caution. Inflation remains stable, with the CRB index in a long-term uptrend but no specific breakout. The Baltic Dry Index is declining, and most commodities, with the exception of copper, are soft, pointing to a lower inflationary environment. The dollar continues to weaken, which has supported stocks, but a dollar rebound could create headwinds. Bonds are underperforming equities, with junk bonds at highs, with the 10-year yield at 4.35%, a level to watch, as 4.5% could start to pressure stocks. Now moving over to the deep dive update. The S&P 500, Nasdaq, and the broader markets, such as the NYSE and Wilshire 5000, are showing strength, with over 80% of stocks above their 50-day moving averages, a sign of broad participation. The advanced decline lines, Chaikin money flow, Chaikin oscillator, accumulation distribution are all positive, but warning signs are flashing. The RSI is above 70, with the bullish percent index at extremes, and the mass index weekly chart has triggered a potential reversal signal, though it needs to be confirmed with other indicators. The short and long-term VIX, a measure of market volatility, both remain below 20, with declining momentum, reinforcing bullish sentiment. However, extreme optimism and overbought conditions suggest a possible pullback at some point. Seasonally, early July is favorable, but high valuations and rising yields call for vigilance. Now moving on to the What to Watch update. First area to look at, employment. The job report released on Thursday was encouraging, but continuing claims are still high at 1.96 million, which is nearing the 2 million threshold, which could raise additional concerns. Interest rates, the 10-year yield, as stated earlier, is at 4.35%, still under the 4.5% level. The yield curve, specifically the 10-year to 3-month spread, briefly inverted, is now back to even and should be watched as a potential recessionary signal. Volume was low, driven by the shortened week due to the holiday, and it may continue to be low as we move on through the summer, potentially amplifying price swings. Looking at sectors and bellwethers, semis, financials, and AI-driven ETFs remain strong, but retail, transports, and regional banks are improving but still lagging. Geopolitical risks still show that tensions involving Iran, Israel, Russia, and Ukraine remain on the radar, alongside rising continuous claims and declining second quarter earnings estimates. The dollar currently is in a solid downtrend, both daily and weekly, currently in the high 96 range. This has been supporting stocks, but an oversold rebound could create resistance for stocks. The big question that's being asked this week, will the S&P 500 keep hitting new all-time highs? The trend is bullish, with broad participation, but overbought signals, including the RSI, McClellan Oscillator, and Mass Index, suggest a potential slowdown or even a pullback. No confirmed reversal yet, but caution is advised. In conclusion, and looking ahead, the markets are riding a wave of optimism, driven by strong employment, stable inflation, and positive seasonality. However, overbought conditions, high valuations, and rising yields warrant cautious optimism. The economic outlook remains solid for now, with no major recessionary signals. The current reading from the SOM Rule recession indicator is at 0.17, well below the 0.5 that causes concern. GDP growth outlook still remains steady at between 2 and 3%. We need to keep an eye on employment trends, yields, and small cap performance for clues about the market's next move. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.